Hi everyone, this is Dr. Barry, and today we're going to be talking about types of insurers and marketing systems from Chapter 5 of the Rada McNamara text. And as you can see, this lecture is split into types of insurers over on this side, and on the right side, marketing or distribution systems. Let's get started. There are basically four main types of insurers: stock insurers, mutual insurers, reciprocal insurers, and then there's Lloyd's of London, which is in a category of its own. These circles shouldn't be interpreted to represent the number or even percentage of insurers in the marketplace. The largest percentage of insurers are either stock insurers or mutual insurers. But Lloyd's of London has such a significant role in the world insurance marketplace that it's worthy of its own big circle. So let's talk about each one of these individually, and we'll also talk about some other forms. Stock insurers are simply insurance companies that are owned by shareholders. So similar to just about any other large organization you can think of, like Walmart or Microsoft or Procter & Gamble. When the company is profitable, profits go to retained earnings and or to shareholders in the form of dividends. Some are publicly traded and others are closely held. And when we compare the stock insurance form of organization to a mutual form, one thing to remember is that it's much easier to start up and get capital for an insurer that is formed as a stock company than for a mutual company. But to make sense of that, let's now turn to a discussion of mutual insurers. A mutual insurer is an insurance company that is owned by its policyholders. In a sense, you can think of the policyholders as shareholders in the company. And the way that it works is one policy with that company equals one share. Many insurance companies that are mutual companies were started by small associations or groups, such as farmers, religious organizations, or some kind of industrial organization. Some of those grew very large, and the best example of that is State Farm Insurance, which is still today a mutual insurance company. Stocks and mutuals have the similarity of both being for-profit organizations. But back to my comment about stocks being easier to start up than mutuals. If you think about this, it makes sense because let's say that you decided you wanted to start an insurance company. The first thing that you would need to do would be to develop the infrastructure, the underwriting capacity, the technological capacity, and other expertise that you would need for running the insurance company. Plus, you need an immediate amount of capital to meet the regulators' capital requirements to start an insurance company. And this is logical because as soon as you start writing policies, you need to have a certain amount of surplus in order to pay claims as they arise. Well, if you're a mutual company, how do you get capital? Your owners are your policyholders, so you only get capital once you sell the policies. So therefore, it only makes sense that a mutual company would have to start small. Now let's talk about the reciprocal form of insurance organization. First of all, the reciprocal form is owned by its members. So it's somewhat similar to a mutual company in that the people that are insured by the organization are also part owners in the organization. So a reciprocal is most like the mutual form of company. It is not for profit, however, so that makes it different from a mutual company. Only a small percentage of property and casualty companies, no life companies, are reciprocals. The administrator of the reciprocal is known as the attorney-in-fact. The attorney-in-fact is purely an administrator and shares no liability for the losses of the insurer. Both mutuals and reciprocals are considered cooperatives. And as I said, reciprocals are most like mutual companies, but the big difference is that the reciprocal is not for profit. However, if the reciprocal collects too much in premiums, over time that develops a surplus and eventually the members will be awarded a return of some of that money. On the other hand, if the reciprocal premiums are set too low, then there might actually be an assessment against the members to pay for losses as they have arisen. But the idea of a reciprocal and a mutual, both cooperatives, is that policyholders share in each other's risk. Now let's take a look at the largest writers in the U.S. and their organizational form before we move to Lloyd's of London, since Lloyd's is not a U.S. company. First of all, note that worldwide the life, health, and annuity industry is about 60% and the P&C industry is about 40%. In Louisiana, it's actually the reverse, by the way. Property and liability, or property and casualty, is 60% at $10.4 billion, and life, accident, and health is about 40% at $6.9 billion. The industry as a whole, by the way, is about $1 trillion worldwide. Let's look closely now at the rankings, first of all, of property and casualty insurance premiums by direct premiums written. And most of this information is taken from SNL Financial, but I've actually added a little bit with respect to the organizational form here. Note that State Farm is the largest property and casualty writer in the United States, and it is a mutual insurer. And it has about 10% of the market share, which is very significant for the United States. Liberty Mutual has about half that at 5%, and it too is a mutual organization. The next four are Allstate, American International Group, which is AIG, you might have heard of as well, Travelers, and Berkshire Hathaway. All of these are stock companies. And then number 7 is Farmers Insurance Group, which actually is owned by Zurich, a stock company, but some of the subsidiaries within Zurich are reciprocals. Nationwide, which doesn't write in Louisiana, by the way, happens to be a mutual company, and Progressive, which is a stock company, and then USAA, which is a reciprocal. It is an interesting organization because in order to be a member of USAA, you have to either have served in the military or have a family member that served in the military. Now let's look at the top 10 writers of life insurance and annuities. In terms of life insurance, it's interesting because, as you can see, nearly all of these are stock companies, and this used to not be the case. In fact, the largest life insurers used to all be mutual. But many of those mutual companies have been absorbed by other companies. So as you can see, a large percentage of market share from MetLife, and the only mutual company now in the top 10 is New York Life Insurance. Now let's talk about Lloyd's of London, a really interesting organization and one that has a huge impact on the insurance industry. But let's be clear. Lloyd's of London as an organization is not an insurance company. It's actually a marketplace for insurance exchanges. So it's in a way analogous to the New York Stock Exchange, which is a marketplace for trading stocks. Lloyd's syndicates, which are members of Lloyd's, are the insurers. The syndicates are all part of Lloyd's, and there are about 90 syndicates that are members of Lloyd's. And now I'd like you at some point to take a look at this YouTube video, which is a history of Lloyd's. It's a pretty short video that's fairly entertaining, and it gives you a good idea of how Lloyd's came about and the role it plays in the world marketplace for insurance today. But for now, let me just mention some of the types of risks that Lloyd's is well known for insuring today. They're well known for coming up with creative solutions recently for insuring cybersecurity risks. They've been known for many, many years to be the first and largest to insure aviation risks, as well as satellite risks and other risks associated with space exploration. And global warming is a huge initiative right now with Lloyd's in trying to come up with solutions to insure all the risks associated with climate change. Lloyd's syndicates only write in the United States in the excess and surplus lines, or the non-standard market. This is because Lloyd's is actually what we call an alien insurer, which means that they're not based in the United States. The surplus lines market is well known for insuring high risks and risks that can't be insured in other areas, which we've talked about briefly before. And you can also see another video about how Lloyd's works. Again, I'm not going to show this video within this YouTube video, but I'd like you to go into the Prezi and take a look at it because it's really quite interesting. And then there are a few other forms of insurers that are worthy of mention. The first, healthcare only Blue Cross Blue Shield plans, are very much like typical insurers. Some are for profit and others are not for profit. And HMOs, health maintenance organizations, including Blue Cross Blue Shield. We'll talk more about these organizational forms when we talk about healthcare toward the end of the semester. And then there are captive insurers, which are insurers whose sole purpose is to actually insure their parent company. So they only have one client. And essentially this is kind of a fancy form of self-insurance. And this would only be for very large organizations like an oil company or a large retail company. Because again, it's like funded retention or self-insurance. But the primary reason companies will do this is because of the tax advantages of having insurance and to take advantage of having a third-party administrator, and yet they're large enough to self-insure. All right, now let's turn to our discussion of marketing or distribution systems in the insurance business. In the insurance industry, the term distribution systems means a lot of different things. When you think of the word marketing, most of you probably think of advertising and sales promotions and other kinds of sales, but distribution systems is far more in the insurance industry than just marketing. It involves a great deal of risk management consulting and other ways of making the insurance marketplace work. The term producers is a term that's broadly used to describe all insurance agents and brokers. And I want to dispel a myth that most people assume that insurance agents or even insurance brokers are commissioned salespeople who the more they sell, the more money they make. But the reality is that most insurance professionals that are part of the distribution system are not commissioned. They're salaried. They may be bonused based on their performance, but again, most are not actually commissioned. Now I want to discuss some important terms related to distribution before we look at the parties that are involved in the distribution system. The first, and a really important term, is binding authority. This is the ability of the agent to underwrite, where underwrite means to bind the company to a risk, or in other words, to actually issue the policy on behalf of the company. And it might also help to think of it in terms of binding the company to a risk. And in common terms, it's known as having the pen for the insurance agent. The next term is ownership of expirations. This is the ability of the producer to take business with them if they no longer represent the carrier. When the policy expires and comes up for renewal, the insurance agent or broker that does not have ownership of expiration cannot contact that policyholder and even let them know legally that they've left that carrier. But if they do own the expirations, then it is their prerogative to contact the policyholder and let them know that they no longer represent that carrier. So it's literally about owning the contact list. Let's start with the exclusive agency system. Generally represent only one insurer. Examples include all of these: Allstate, Shelter Insurance, American National, Farm Bureau, and State Farm Insurance. Some important points about exclusive agents. They generally sell insurance for less complex risks. So they're very successful in selling personal lines insurance like homeowners and auto and life insurance. The carriers that they represent generally do not sell in the surplus lines, such as State Farm and Allstate. They generally cannot even access the surplus lines or non-standard markets, so they wouldn't be able to access a Lloyd's insurer. In fact, generally, they only represent one company. An Allstate agent could only sell insurance for Allstate. Some of these companies actually do have a couple of alternative carriers, but again, they're very limited on which insurance companies they can sell insurance from. And in some cases, they do have limited binding authority. That binding authority is limited based on limits that they can actually issue and on different characteristics of the risk. They are not, however, the owners of expirations, meaning that the company actually owns the contact list. And so if they terminate their relationship with that company, with Allstate or Farm Bureau or State Farm, that agent or producer has to develop their business from scratch. Now let's talk about the independent agency system. These producers represent multiple insurance carriers. It includes agents and brokers. Brokers represent the policyholder. Some examples are Willis, Aon, and Arthur Gallagher. Agents typically represent carriers, but they represent more than one carrier. Some important facts about the independent agency system. While they do place simple risks, they are especially good at more complex risks. Brokers tend to place and represent the largest and most complex risks of all. Brokers do not have binding authority. Agents generally do have limited binding authority, but brokers and independent agents are owners of expirations. And they can access the surplus lines through a wholesaler or managing general agency, also known as a surplus lines licensee. And that's the end of our discussion of types of insurers and marketing systems.